no true is not enough.
Hey guys, welcome back to part 2 of bonds. So today we'll basically just be talking more about bonds, but specifically the types of bonds, and we'll be talking about 3 specific bonds: corporate, municipality or munis, and government bonds, and their benefits and what they basically do. Let's get started. So we have a lot of types of bonds. There are a lot. So we have U.S. Treasury bonds, U.S. government bonds, municipality bonds or munis, corporate bonds. We have foreign bonds, convertible bonds. They are a type of corporate bonds. Non-conventional bonds. They are a type of corporate bond. Preferred stocks, adjustment bonds, junk bonds. Junk bonds are also a type of corporate bond, and zero coupon bonds. So first, I'll start with zero coupon bonds. They're also called accrual bonds, and they basically don't make any coupon payments, but it is issued at a steep discount. They can be redeemed for its full value upon maturity, and they tend to fluctuate in price more than coupon bonds. They can be issued by the U.S. Treasury, corporations, and state and local government entities, and generally have long maturity dates. They don't have any coupons. That's basically what it means. You can see as in the name. Next, we have foreign bonds. Foreign bond is a bond issued in the domestic market by a foreign entity in the domestic market's currency. They're basically bonds from other governments. That's basically all you have to know. If you want, I'll give you links to research them. I'll have links for all of these in one site, and I'll make sure to have them posted in the description. I'll also have different brokerage accounts that you can look at if you want to start investing immediately. I'll have different brokerage accounts in the description below. Make sure you look at that before you invest in any of the different types of bonds, because bonds are a little bit more advanced in the sense that they have a lot more stuff to deal with them. And make sure you look at my video before for any of the key definitions that you might want to know before you start investing in bonds. So convertible bonds, these are corporate bonds. They're also referred to as CVs, but they're basically a type of corporate bond that the holder can convert at any time to shares of the company issuer of the debt. So basically, they can be converted to stocks. That's basically what it means. But the number of shares that it can be converted to is predetermined. Non-conventional bonds. So conventional bond, first of all, is sorry. Non-conventional bonds have rates and maturity which vary and change with time. Conventional bonds are basically, they don't vary and change with times. They stay the same, and the rates and maturity stays the same no matter what. Zero coupon bonds, like I said before, they are a type of non-conventional bonds, and the most common issuers are governments and corporations. Preferred stocks, basically, yeah, the name is confusing, but these are stocks, but they also share some things in common with bonds. For example, just like common stocks, they pay regular dividends, but similar to bonds, this dividend is predetermined and fixed. Like I said, bonds are fixed income securities. Adjustment bonds, they're basically types of securities that are issued by a company due to the process of recapitalization or restructuring, and the time this is issued in the time of change when they need money, especially for recapitalization or restructuring. The outstanding debt of the corporation is transferred to the adjustment bond, and they're given to bondholders. This is required because the company wants to change the terms of its obligation in order to be able to escape default. Junk bonds. Junk bonds are also called high yield bonds or speculative bonds. Like speculative stocks, there's a corporate bonds with the lowest rating possible, so a D, and their names suggest that they are high risk and high return assets. So high risk, high return. Like speculative bonds, you don't know what's gonna really happen with them. U.S. Treasury and other government bonds. They're basically the safest investments on the market because they are secured by the U.S. government. Same thing as well with other governments in general. They don't have to pay state income taxes on interest. They are the weakest performers when it comes to profit because they have very low interest rates. Because they are the safest, and like I said before in my other video, that the higher the risk, the higher interest rate you'll get. But they're gonna give you the money back here. They are gonna give you the principal money back. So other government bonds can be released by government agencies. So the government agencies can be like Fannie Mae or Federal National Mortgage Association, or Ginnie Mae, which is the Government National Mortgage Association. And these offer higher yields than Treasury bonds, but are not exempt from state and federal income taxes. So I mean the government agency ones. Next one, corporate bonds. They are riskier but more profitable. They're kind of like stocks in the sense, but they are coming from a company, but they have the same bond value and bond terms and stuff like that. So corporations can issue stocks and or corporate bonds. They're both used to make raise money. There are short term, intermediate, and long terms, 5 years or less. They're all talking about maturity, but 5 years or less, 5 to 12 years, and more than 12 years. I've seen actually a lot of bonds that are usually between the short term and midterm, intermediate. So meaning less than 5 to 12 years maturity. But there are several types of corporate bonds. There's a straight cash, which basically means pays interest at regular intervals and at maturity pays back the principal, meaning a regular bond. The split coupon acts as a zero coupon bond, meaning there is no coupon. But in this one, it does begin pay interest at a specific date. So you do have a zero coupon bond, but at some point you're going to get an interest as well. Pay in kind, high risk loan where borrowers pay interest with additional debt. The floating rate has a variable interest rate. This is kind of like a non-conventional bond. So basically, the variable interest the interest rate always is varying over a period of time. The increasing rate deferred interest, it pays interest in full only upon maturity. Basically, you have to wait for that interest to be paid when the bond matures. Next, we have municipal bonds, also called munis. It can be used to fund specific expenditures or projects like the construction of highways, bridges, or other projects in infrastructure. The interest is tax free federally. State taxes are neglected if the bond is issued in the state the investor lives in. So if I live in, let's say, Oklahoma, and if the bond is issued in Oklahoma, then state taxes are neglected. But if I live in like Louisiana and the bond is coming from Oklahoma, state taxes are not neglected. So the types of municipal bonds are general obligation. Basically, they're state or local governments pledging to use legally available resources to pay back money. So tax revenues, anything from the treasury, revenue municipal bonds, guaranteed repayment solely from revenues generated by something associated with the purpose of the bond. So if I paid, if the bond is for like a highway, any of the tax revenues I get from the highway are given straight to me. So I basically have it's basically like I paid for the highway kind of in that sense. But anyway, next one, anticipation notes. Short-term bonds used to generate funds for future projects. So basically, it's not for a project in the current, but it's for a project that the municipality is going to do or something like that. Insured municipality bonds. Basically, insurance companies will pay interest and payments timely if the issuer defaults. This is not very common just because municipalities don't tend to default on their bonds, but it's just you're protected if that happens. So that's the end of the types of bonds. If you guys have any more questions about the types of bonds, feel free to type it up in the comments. If I said anything wrong, or if my information is outdated, please tell me and I'll address it in the comments. There is going to be websites and brokerage account websites that you might want to look into. I'll post other websites that can look into different kinds of bonds. But most of the bonds that you want to kind of invest in is going to be government bonds and corporate bonds, just because they're more straightforward and the and you can make money in the long run. If your sole purpose to live is to invest in bonds and make the most money possible, I feel free to go in to web and research as much as you can about bonds. The main thing is I want you to be able to research and know exactly what you want to get out of it. I might make more videos of bonds, specifically going to each type and making sure that you guys understand every single type and what they do and what it comes from and stuff like that. And they're probably going to be like shorter 5 minute types of videos. But for now, that's basically it. Make sure you subscribe to Corsa. Make sure you check out the other uh, channels or the other courses on Corsa. I'll post a link for the channel homepage. Also, make sure that you hit the bell icon for post notifications. Make sure you like the video, and again, feel free to comment any questions that you have. I'll make sure to answer any information that you think I said that is outdated or is inaccurate. Please feel free to tell me in the comments, and I'll make sure to address it. Thank you so much for watching, and stay tuned for the next video on Investing 101.